Let me start the webinar. Good day to one and all. This is Dr. Sivaram of iknowindustries.com. I give once a month a twin webinar titled Tracking Live the Forex Market Together. For the month of October, today 19th of October, I am presenting the Tracking Live the Forex Market Together Part 1 and Part 2. Part 1 between 8 and 10:50 GMT for almost close to 3 hours, and between 14 and 15 GMT as Part 2. Now, what is the main purpose of having such a long webinar? You might be wondering, normally the webinar could be for about 45 minutes to 1 hour. Then why it is of a prolonged nature? This is mainly to explain and also make the audience to understand how the live market quote page alone is enough as the most reliable trading tool, and thereby you will be able to really make less stress analysis and better results in your trades. So first of all, we need to understand stress is nothing but an imagination. So we assume that it is a very difficult task. We assume that it is very hard to understand. In such a situation, in confused state, the mind becomes surprised when something unexpected happens. Then that leads to that of the market fear and the tension. Then in such stressful condition, you find that whatever the chart you look into, it might look different. So a bullish person after the stress might feel the market might drop endlessly. A bearish person might assume when the market goes against that it can gain to that of infinity, so they will go in for a distress trade. Then in that process, find the long holder liquidate after the drop the position and accept the loss. Similarly, the seller go in for a short covering and accept a big loss. After that, they realize that they have done a faulty thing, or they could have waited. So basically, it is the question of whether one has to be patient or one has to be stressful, or one has to take quick decision. Probably the patience might make the loss to grow. So how exactly such decisions are to be taken? So we need to understand the limitations of human psychology. So in the case of human, you know that the mental perception, the psychological expressions, etc., are all controlled by that of the endocrine system. That is the ductless glands. They just influence the brain. As a result of that, you come across the distress actions happen. Whenever a person becomes emotional, he is not able to control his action. And that is why you find 99% of the crimes are committed in the world only when the criminal is under emotional stress. So when a person does a crime to other person, it is punishable. Whereas if he is doing the crime for himself, other than suicide, it is not considered as a crime. So when he takes a wrong decision and close a position with a big loss, it is a crime, but the punishment is instantaneously given in the form of the laws in trading. So there is no social punishment needed in such a situation. So as far as traders are concerned, they come to the market mainly to understand well the market so that they can trade and earn money from the market, which they need for some other purpose, which they will not be in a position to earn in ordinary means. Suppose a person is having a salary of $2,000 and he has got an urgent expense for about $10,000, then immediately he thinks that market is the only scope. Other than that, he can borrow and pay it in installments. Instead, he comes to know about the market. So he thinks that he can deploy some money in the market and earn from there quick money. So basically, people come to that market not by making money in an ordinary means, and they wanted to earn quickly the money. In a matter of about 10-15 minutes, they want to earn thousands of dollars. So they also know that more risk, more reward. So they don't mind taking the risk, and so that they can easily see a big reward coming, a jackpot coming. So they go in for such high risk reward trades. Invariably, there is no one to guide in the market. If you go to any analyst website, if you go to any of the website which is talking about the market and also the Forex trading, you come across a big paragraph of disclaimer that one has to take his own decision. One has to really think about before entering into the market. When he is going for a trading, he is risking his money. So these are all the advices or precautions given to that of the trader. The trader gives less responsibility or give less importance to that particular statement because he thinks that it is given in smaller letter as a statutory warning, which may not happen. Because most of the warnings in a drug or any other place you find, or an electronic gadget, you come across a warning that you should not keep it near that of the children, etc. But they are all given in small letters when compared to that of the salient features of that particular gadget, which is given in bold letters. So when statutory warning is given, they think that it is mandatory for them to publish it and it is nothing to do with them. Then later on they realize that trading in fact is such a dangerous thing. And if you enter into the market without understanding the depth of it, it is something like straight away you wanted to jump into the sea and wanting to learn swimming. Probably if you want to learn swimming, the first place could be a small pond or a puddle or a swimming pool. Thereby, the risk is very minimal. And also, you will not be developing that much of fear, or it will not give a shock for you, and the water pressure may not be there that much. So as a result, your mind is in a position to focus on learning swimming. Otherwise, the mind will think of only survival. So if you straight away jump into that of the big ocean or the sea, you can only think of survival unless and otherwise you are very familiar with swimming in the sea or the ocean. So you find there is a contingency plan, and the crisis management. So if you opt for the contingency plan, you envisage the risk involved in trading. Then as a result, you think that you have to be cautious while deploying your money into that of the market. The other one is crisis management. That is, you assume, okay, I am a brave person. I don't be afraid of the market. So I'll enter into the market, I'll deploy my money. In the event of any risk comes, I'll just handle it. Let the risk come, then I'll handle it then and there. That sort of decisions. As it comes, I will handle. This sort of decisions invariably bring in more surprise and more stunning effect to that of the traders. So one has to plan well how exactly the trading has to be. It is not simply asking for the risk reward ratio. Okay, following a system, how much of money I can earn. Many of the people ask that. I got about $2,000. When it will become $10,000 following your system? This sort of questions people ask without understanding it is a process. A process is a one wherein you have to assume the responsibility by yourself. It is not that I guarantee the profit on that. You should be able to envisage that you can earn that much of profit. Because I cannot hold your hand and tell you, okay, click here, click there. Okay, you take the position, you close the position. I cannot do that for everybody. And basically, you should be in a position to develop or inculcate a system. Thereby, you will be able to take appropriate trading decision without much of an influence of emotions. So ultimately, the emotional control is vital in trading. There are many occasions you find many of the analysts, they emotionally talk in front of the audience or in front of their clients. Rather than controlling the emotions of the traders, they themselves trigger the emotions of the traders. And then whatever they teach, it may not get into the mind of the trader. It might appear like a small entertainment. He has enjoyed it and he will simply forget about it. So a serious learning process is a must. There is no question of jokes and other things involved in it, because it is a serious matter that how you are going to plan your risk. And when you are planning your risk, then obviously you have to be very attentive. You have to be very, very careful in understanding the intricacies of how to limit the risk. So giving a vociferous talk, giving a extempo talk, and giving a lot of jokes in between, that might be all right if I'm entertaining you people on some cause or some topic. But when it is a question of learning, it is like a classroom situation wherein one has to be very attentive, and only then the learning process happens. I have been giving this Tracking the Forex Market Together webinar for more than 10 years in FX Street. And earlier I used to give twice a month. Initially I started as weekly once, then twice a month. Then for the past 4 years, I am giving once a month. But in spite of all the explanations I give in Tracking the Forex Market Together webinar, and also give on Mondays the Asian Session Live Market Analysis webinar explaining the forecast, market reading technique, and the trading strategy, you come across the questions from the traders that whether euro will go up or come down. So they want only the result, and they do not want to learn anything. It is something like that you wanted to reach the destination by getting into the car without knowing how to drive the car. The only option available is you have to hire a driver. But once you hire a driver, then what happens invariably, the driver will have his own style of driving, which you may not be able to accept in total. But whereas if you drive on your own, you will have your own driving style, and you know how to apply brake, how to apply the clutch, etc. Then accordingly, you will not have any sort of unpleasant situation when you are driving. But somebody is driving on your behalf, then automatically you find that the other person is making a lot of mistakes. But the same mistakes when you do, you simply say that the market is crazy, which has gone against your expectations. Whereas if somebody else has done the same mistake, then immediately you yell at him and say that, oh, he does not know how to drive. A similar situation happens when you hire a person for driving or hire a person for trading. Instead, you are also having enough health. You are also having enough mental strength. You are also having the necessary facility to trade. In such a situation, why not you equip yourself? So if it is a two-wheeler driving, then you need to develop an additional skill, namely balancing. But here, in a four-wheeler drive, like a car, there is no question of balancing is needed. It is a question of understanding the road, on how exactly other traffics are going to influence you, how exactly you are going to maneuver and travel. So you need to develop the navigational skill, and that we call it in common term the driving skill. So once you learn it, you find that driving becomes a child's play. So if you ask any good driver, then he would have learned driving when he was around 15, 20, 25 and things like that of the age. But when you ask him when he is around 45, 50, you will say that I don't remember how exactly I learned it, but I can drive at ease. I need not really look into that of the front panel. I need not look into that of the pedal where it is placed, or the clutch where it is placed, gear where it is placed, etc. And once he has learnt in one particular vehicle, he finds that driving in other vehicles with a slight modification becomes much more easier to learn. What is the basic idea in it? First of all, to develop the driving skill, one need to develop the confidence that, okay, I can drive. I am capable of driving it, or I am capable of learning the art of driving. So the self-confidence is needed. So once the self-confidence is learned or acquired, or which is being rejuvenated, then you find my system becomes a very effective and very simple trading strategy. This trading strategy consists of three components, namely the derived forecast, then the market reading, and the trading strategy. So where you need to deploy your mind, the market reading and the trading strategy. The forecast, I am giving it free in FX Street on on Mondays. So on every Monday, I give the Asian Session Live Market Analysis webinar explaining the session-wise trades, or session-wise how exactly the market is expected to move. So that is a broad guidance for you to reduce the uncertainty And at any level, when euro is here or GBP is here, we like to know whether it will go up or come down. So all the analysts in the world are trying to explain to you nothing more than that. What is the probability whether it can go up 70% and come down 30%, or come down 70% and go up 30%? So when the analysts say that 70% it will go up, then you try to take a buy, and when the market goes up, you appreciate the analyst and book the profit. But 30% when it comes down, then your usable margin is eroding, which triggers your fear. Then once the fear grips in, you fail to follow his system. You try to just yell at him and say that this fellow has really misguided me entering into the market. When all other analysts were telling that the market will come down, this person was telling that it will go up. So first time I took a buy and I was able to book profit. Second time when I took a buy, which has come down, then he has really terribly misguided me. So let me close it with a loss. It is something like slapping that particular analyst. He closes the position accepting the loss. Probably he can just discontinue in following that particular analyst, but the loss is his. He has lost his own equity, not somebody's equity. Besides, he has not learnt anything out of that, because when the fear grips in, when the emotion was dominating his reasoning ability in the brain, then he takes emotional decision of closing in the dropping market, the buy position. And later on, he finds that the market is going up. Then still, you think that, yeah, as he said, the market has gone up, but he could have given a better entry level for me. So still, you try to point out the finger to the other person. So how to get rid of all those things? It is very simple. There is no point, there is no earning process when you blame somebody and you only lose your health, or you only get only mental stress, and because of that you find that your health deteriorates. So the other person is not losing anything. Probably you would have lost a client, that's all. But as long as you are concerned, you need to perfect your trading system, and you should not learn out of the mistakes again and again. So if you continue to learn out of the mistakes, then what happens? The learning becomes a very, very expensive process. Suppose you have got about $10,000 and you just try to enter into the market and trade. And in the process, you find the margin call. You have blown up that account. Then somehow you manage and develop another, generate another $10,000 and use it as an equity to earn back the lost money. And in that process, you try to follow somebody and you try to read many magazines, you read many websites and look into that of the analysis, etc. Then you blow out that account. Then $20,000 are lost. Your main objective of entering to the market to multiply this 10,000 into 50,000. In that process, you have lost 20,000. Then if you want to continue in the market, you have to generate another 10,000 and just enter into the market. Nobody will allow you to make free trading unless and otherwise it is a demo trading account. So in such a situation, the trader is under tremendous pressure. He does not know what to do. And see, he has entered into the market because of certain unexpected commitments, which he will not be able to meet by his ordinary means. So in the process, he thinks that, okay, trading is a strategy which can be used, or it's a mechanism by which one can generate the money. And initially he thinks that he can do it as a part-time job. Then after some time, he finds that whenever he is away from the trading platform, great trading opportunities were there. Whenever he is in front of the trading platform, he finds that trading opportunity is very limited. Then he is not able to focus on the job. So he becomes unfit for the job and he quits. And instead of looking for alternative job, he asks many analysts, can I do trading as a full-time job? It is something like you try to learn driving and you thought that you can use the driving to go to the office. And in the process, you met with several accidents and later on lost all your confidence and the money and asking others, can I become a driver and drive the vehicle for somebody? The situation of that nature happens for predominant of the traders. My mission is to change the mindset of such traders. Make them to understand that trading is an art. You have to learn the art. You have to learn the skill sets required for trading. Once you develop the mindset and the skill for trading, or a quick decision-taking ability for trading, then you can follow the forecast, you can do the market reading on your own, and the trading strategy. Then you find that by following all the three, you are able to consistently earn money from that other market. If you take only the derived forecast alone and say that it is not working for me, it is something like you are trying to take only the front wheel of a bicycle, and say that no, I am not able to use it effectively. Similarly, if you take only the back wheel of the cycle, and it is not a bicycle, it becomes a motorcycle, and you need extra balance for that. Only then you will be able to drive it, like how people are driving it in the circus. But you wanted to drive a bicycle. In that case, you need to have the derived forecast and fine-tune the forecast using the market trading technique. It is not very difficult to learn. I've been telling it. It's probably more than a lack of times. I would have just explained the method of how to do the trading. Still, I find that the traders want still shortcut methods of earning money. It's all because the mind becomes fatigued, lethargic, and the mind wants quick results without the process. So if you don't learn properly, you will not be able to qualify yourself with a degree, or you cannot take up the examination. So without learning, if you want to take up the examination, it is a question of only chance. And always the chance may not be in your favor. So first of all, understand that even though I give the derived forecast for every week in FX trade for so many years, and if you ask how many people have earned money out of that, there are some who think that it is given free, so it may not have any value in it. Certain other people might think that, okay, he is talking in a different term, which is quite away from that of the other analyst. They never say that swing in the market. They use the charts, whereas he is not using the chart. He is only using the live market code page. So you try to make a comparison of that nature, and invariably you just block your own acceptance. Because basically, no one need to understand that mental acceptance is the most important thing. Suppose you are in front of a stranger. First of all, you have to tune your mind that you are in front of a stranger and he looks different from yourself. You are white skinned, whereas he is brown skinned. So you find the variation. He might be belonging to some other country. And then you try to talk to him, but you find there is no common language between you and him. If you speak in English, he is speaking in some other language. So you are not able to understand him, or he is not able to understand you. Then it carry on for a few minutes, or probably even 30 minutes to 1 hour. Then later on, if you are interested in negotiating with him, try to understand. You try to develop the body language without your knowledge. And he is able to understand your body language. And he simply says that nodding, yes, I understand. Then you find that the body language becomes a common language for both of you. And later on, you just slips while walking, and he extends the helping hand without knowing your language. Then you understand the care for yourself. So when he is extending the care, it does not have any boundary. It does not require any common language to be understood, or it does not require the same skin color. Ultimately, what is most important is the care needs to come from within. And that is what I am trying to preach here, so that you will be able to really understand that when I care for you and try to give you the forecast, if you make use of it, definitely you will be able to really earn nice money from that market and quit trading. Because many of the traders look for analysts and they try to discuss with various analysts and say that I like this analyst, I like this second analyst, etc. After some time, you realize that nobody is perfect. Then you become demoralized. But there is no need to become demoralized. What is most important thing is understanding your own requirement. Suppose you are hungry, you wanted to eat food. And if you ask somebody to eat food, can you be satiated? Can your stomach be filled? Not at all. So if you are hungry, only you can eat. If you are sick, only you can take medicine. Even your mother cannot take medicine for your cure, which she is supposed to extend unconditional support to the child. So you find that if you want to earn money from that other market, only we have to learn it. If it is a very hard thing, and probably you find it requires a lot of mathematical calculations, it requires perfect understanding, etc., then it might be a difficult task for you. Whereas I have made it so simple in common language so that you will be able to really follow it without any of a complication. Even a just school boy should be able to learn it perfectly if he follows my method. It does not require any statistical calculations. And you know that in the name of statistical calculations, I wish to say that I am a statistics professor. And in the name of statistics, many of the analysts, without knowing how exactly such statistical calculations are being done, they follow the charts, they follow the lines over that of the chart, etc., assuming that those things are true statistics. When you ask the developers, they will tell you the developer is not very perfect in understanding the statistics. So he expects an expert to explain to him what are the steps, and he just does the coding for such things to be given as an output. And in the process, they don't perfectly really check whether such statistical calculations are being done perfectly. And invariably, I have found out mistakes in many of the charting programs, that how exactly, which is misguiding them, because many of the analysts assume that such statistical calculations are 100% perfect, and they simply use such curves and simply say that moving averages, etc., is as it is. And then later on, they find it is not working because it is not developed perfectly. So what is more important is, it is not that you become a perfect chartist. Also, the tool has to be a reliable tool, back-tested tool, and you don't do all those things. Simply, it is given free. You assume that you can take it, and you just take, for your curiosity, the charts which are shown in FX Street. There are various providers giving the charts for the same live market. Just open it in different windows in a frame and just look into that of the chart, how exactly they are being formed. You'll be able to really understand how every chart is showing different method of deriving it, and they show a different picture altogether. So if you make an objective analysis of that nature, then you will understand that chart making requires more skill set, and only then the perfect charting can be done without time delay. And also, in the chart development, some intricacies are not being taken into consideration, because the analyst also, suppose you find that the high set for today, in the case of euro, is 1.0999, and you find that euro just stayed there for a second and come down, holding around 1.0994 for a long time. Then immediately the chart will say that it is only a small linear line, because it was just retained there for only 1 second. Then when you look into that of a 15 minutes chart or the 30 minutes chart, it will appear like a noise. But suppose you placed an order there, the order would have been filled. But if you follow the chart will say that that is not filled. It is only a noise. Or it would have been filled in some platform, or may not be filled in some other platform. Suppose you have got a stop there, and the chart will say that your stop would have been filled or may not be filled. We are not very sure about it. But if you think next time I should keep the stop 10-15 pips above, and if there is a still high level, the market goes down and goes up and comes down, then immediately the chart will say it is a noise. But your stop would have been filled. So how far you have to be keeping the stop away from such logical levels which are derived in the form of pivot points or supports and resistance, etc. But in the live market code page, you find the exact point wherein they just made a turnaround is visible, which is not visible in the charts, unless and otherwise you see a tick chart. When you follow the tick chart, the purpose of using the chart is defeated because you wanted to make a figurative comparison. When you want to make a figurative comparison of events, it is something like trying to compare two human beings. So when you keep two human beings adjacent to each other, they look almost similar. You find it extremely difficult to find the differences. Then invariably what happens, you try to draw an outline of both the individuals and find out the difference. You find the difference becomes much easier. You are able to point out the differences when it is in two-dimensional rather than three-dimensional. So the chart is nothing but the two-dimensional expression of the events. When a two-dimensional expression of the event is seen, you are suppressing the three-dimensional market. The dynamicity of the market is being reduced and it is given in two-dimensional condition. So you need to understand at every level how long it is staying, how long the market is staying in every level. Then you go in for a 15 minutes chart and 30 minutes chart. Then you go in for a candle formation and try to find out what happened in 30 minutes. What is the high, low, and the net change, and also what is that as the highest peak they are reached, lowest level they are shown, etc. You just do it in the form of a candle study. In the candle study, what happens? You are not able to find out the exact time frame at which that particular high was set or the low was set. So there are various compromises happening in chart study. And when I continue to explain all those things, people will be able to realize it. But that is not my objective at all. See, being a statistics professor, I want to really say that the charts will be working very nicely for the traders if the market is not being manipulated. If the markets are being manipulated, there is no question of looking into the chart. See, when I was talking about it in 1995, 99, people were telling that market cannot be manipulated. It's such a huge market. Maybe the regional stock markets might be manipulated, but not the currency markets. Then slowly, people started telling when the chart study is not working, when they go in for various type of new combinations of chart study, they find that still they are not probable indicators of the market trend. Then they say, yes, market is being manipulated. And they don't openly say in public, they say in private chat or in private discussions, because they think that people who are involved in such operations might harm them. Let me tell you one thing. I've been talking about the operators and the market players from the beginning for over than 19 years, and they have not caused any harm to me. For the simple reason, if they cause any harm to me, then they will be exposed that they are the players. So first of all, understand that the players have got the limitations as long as they are human. If they are gods, nothing can be done. If they are human, they have their own limitations. There are so many successful criminals in the world, they survive. And we have seen there are so many successful people who have conquered the world. But when you look into the end, then you will find that they also died like an ordinary person, not like a rich man in the world. Like an ordinary person. Yes, they have died. Because as long as they are human, they will have the limitations. They will have the fortunes. And they will have the ups and downs in life. So, what we do is, we read the limitations of the players by doing the market reading. We read the limitations of the players, not the strength of the players. We read the limitations of the players. by understanding the type of moves they are doing it in the market. Because the limitation is they have to be cunning. They have to, first of all, pretend the market is following technicals and fundamentals. Only then the traders will commit positions. And later on, they will say, okay, it is because of technicals the market has just reversed, which was unexpected. Or it is because of the fundamental the market has reversed, which was unexpected. So you come across that the market reversal is the prime danger for the traders. So the trend reversal for the intraday, weekly, monthly, yearly, etc. People are not able to understand when exactly the trend reversal is going to happen and how exactly the trend reversal is going to happen in the market. Because you find by all chart study, the market has to come down, then suddenly you come across the market is going up. Then it is already reversed. And you find that, oh God, I could have taken a buy around that of 1.20 in GBP, which has come to 1.23. I would have earned about 250 to 300 pips. But when it was around 1.20, people were selling that GBP could come down more and more. Probably it can come to parity also. So that is how that fear is being developed and passed on to others. So once I develop the fear and talk to other people in shriveling voice, then automatically those who are listening also become afraid. They also become tensed. They also become emotional. So it spreads. That is how you come across the market sentiments are being created. So now we can understand why such people forcibly bring in emotion unnecessarily when they are talking about the market. When anybody is talking about the market, it is not a death event or it is not something which a calamity has happened. Why they become emotional? Why they are giving an emotional expression as if the world is going to fall? When they do that, immediately the traders following it become bearish or bullish. And they think that, okay, it is a child's play, you better take a sell. It is only a bouncing cat just trying to bounce up and then it is going to drop big. So let me take a sell. That is how he assumes the trade. So whatever be the type of analysis he would have done, he use it to place the stop. So he thinks that, okay, fine, GBP has come to the psychological level 1.23, then let me take a sell and keep 1.25 the hedge order or the stop. So the risk reward is higher. I am taking a risk of 200 pips on the upside and aiming a profit of 500, 600 pips on the downside. Okay, my risk reward is 1:3, fine. It's a profit calculation. That is how he assumes. But if the risk is hit first, when the market goes up and hit the risk or the stop, and later on it comes down, the reward is shown, but he is not having a position to earn that money. So that is not the solution, understanding simply the risk reward. So what is most important is read the intentions of the players, because they are manipulating the market, they are making the market live, and they are making the market appear bullish and bearish. Okay, read their intentions. They just make a bullish feel in the market and suddenly drop once the traders commit buy positions after the rise. They similarly create the bearish feel near that of the low set for the season, when the traders feel that it can fall freely further because the events which are fundamentals are going to be very weak and nobody is going to support the fall. Then he takes the sell, and later on he finds that the surprise happens, the market started going up. Then he fails to understand who is buying, why the market is going up. Unless and otherwise somebody buys at a higher level, how can the market go up? When you continue to keep buy orders around the same level, one lot, even 10,000, 20,000 lots, if you place order, it might be filled. Market may not go up. There won't be any supply and demand situation because there are hundreds of traders who could continue to contribute their sell positions, create the bearish field and hold low. The people will sell. That's what happens. So what the players do, they drop the market, hold low, and pretend as if the market can have a free fall. Then induce the traders to sell, hold low, and continue to keep the buy orders for that, and buy up to 10-15 pips and then again drop. Buy up to 10 to 15 pips, drop. Then the traders feel that the market is bearish. So we can do the swing scalping or swing trades for 20-30 pips. They sell and book profit after the slip. Then later on what happens? Slowly the players gain the levels. Right from the morning, you would have just noticed from that of the Japanese session, slowly they have been gaining the level in the case of GBP, much against the expectations of the traders. Traders were thinking that the euro could be relatively strong, but they are holding it weak, and they are gaining the levels in the case of GBP slowly to that of the psychological level 1.23 and above. So you have to understand what the players are doing at a given time. Based on the traders' commitments, they try to make the moves in the market. So no chart will be able to tell us which currency we have to enter in. You can only look into the charts of various currencies, and you will not be able to get the cumulative information about the market and also which currency they are handling at a given time, so that you can commit position there and earn quickly the profit. So for that, the market trading is vital. Then market means risk. So any market for that matter, as far as you are going for the leverage trading, the component of risk is part of the game. You cannot avoid it. So when you are aware of the risk, then why not you plan it as a contingency plan before the risk comes? It is something like when they have developed the car, automobile or anything for that matter, any moving object for that matter, they have also developed the brake in it. It doesn't mean that the car might commit mistakes. They kept the brake. In the event any surprise happen, then immediately you can apply brake. The danger can be from within or from outside, and they kept the brake under the control of the driver. So similarly, you have to have a contingency plan of how to apply the brake. And you should not do the crisis management, not to be aware of the brake, and later on when the danger comes, you should not search for the brake, where exactly the brake is, how to apply it. So the contingency plan is a must rather than crisis management. So for that, the trading strategy is vital. So this trading strategy is a very simple method of trading, because in the market, there can be only two types of traders. One having a feel that euro could come down. Another one could have the feel that euro could go up. At every level, you find there could be two opinions in the market. One trader A might think that it is a good level to buy Euro is below that of the psychological level 1.10. So it has not come down for a longer time. So we can take a buy. The another person might think that, okay, it has breached the psychological level 1.10. It is staying below that of 1.10 for a prolonged period. So it is not having strength to even go above 1.10. So it is likely to fall. So two opinion can be seen at every level in the market. So there will be buyers as well as sellers in the market. That is why you come across in the market quote page. Sometimes it is green, sometimes it is reddish, etc. Because somebody is selling at a lower level, then the market comes down. When the lower level figure is bid is exposed, then it becomes red. When the higher level bid is exposed, then it becomes green. So market is bullish and bearish at every pip. But overall, there is a bullish and bearish sentiment created by that of the analyst, created by that of the players. Knowingly or unknowingly, the analyst join with that of the players and propagate that feel. Okay, market is bearish, market is bearish, market is bearish. When they continue to say like that, then immediately it spreads like a virus. If somebody sneezes, then you find another person catches the cold. That is how it spreads. In the same way, the bearishness and the bullishness spread. But in the market, there might be some traders who think that, okay, it is better to do a counter trade. When all are bearish, let me buy. There are some traders who take that sort of decisions. So you find at any level in the market, there will be some traders taking the buy position, and there will be certain other traders taking the sell positions. In such a situation, when you use hedging, it is similar to that you are having a buy position as well as a sell position or a sell order. So when both the orders are there, or when both the positions happen to be filled, then you can trade like a bull looking into that of the buy position. Trade like a bear looking at that of the sell position. That is possible, and that I just elaborate as various type of trading strategies using the hedging. I will try to explain to you one or two trading strategies. The other trading strategies, probably, if you contact me, I'll explain to you, because I cannot give it in the open forum. Now, how exactly the trading strategy works? Now, note down the high and the low net change in 4 majors and 2 commodity pairs. They sit between 2:30 and 3:30 GMT. So you have to look into that of the market during that of the Japanese session. At that time, they will quickly make a downward move as well as upward move. If you watch carefully, around 2:30, if they set the high, 3:30 they will set the low. Around 2:30, if they set the low, by 3:30 they will set the high. So by 3:30 GMT, if you note down the initial lows and the highs, which I call it as the initial low and the high, and the players also call it as initial lows and the highs, then that becomes the relative levels for the entire day. Once you note down the entire day, that is going to be the initial lows and the highs are going to be the reference level. Then also you can note down the net change. Here is the net change in the quote page. Now here is showing 17 pips or 18 pips positive net change from that of yesterday US session close. USDN has dropped about 40 pips from that of yesterday US session close. GBP has gained about 23 pips from that of yesterday US session close. That is what the net change refer to. Why this net change? We are not using it for trading, but they are all the bank referral levels, because the banks have got the limitations with regard to the net change. So they can gain or they drop 150 pips net change level for the day. So it is very useful tool for us. And people are not talking about the net changes. It is very unfortunate. Even though it is given in the live market code page, in every code page you come across the net change, people are not talking about it because they are not really interested in helping the traders. They want only to make the traders addicted to trading, lose money in the market so that their salaries are paid. It's a very unfortunate situation. And you know that when a crime is committed, if somebody is supporting the crime and somebody is trying to facilitate the crime to happen, he is also punishable. But without understanding the seriousness, many of the analysts, in the name of analysts, they simply misguide the traders to lose money in the market. What is most important thing for them to understand? They simply say that market is $4 trillion move and it cannot be manipulated by anybody. How the spikes happen? Suddenly somebody shows the interest in buying, so the market he plays by order and thereby it goes up. They simply give all wrong informations to that of the traders and making the traders to believe that is how the market is. But it is nothing but the total manipulation in that of the bank terminal by which they are making such spikes. When they make such spikes, you know, so many traders suffer because of the margin call, because the order is not filled, the margin is totally eroded, etc. And they simply give a warning. Then during that of the data release time, we don't have any control over that of the trading platform. They simply give such disclaimers, and it shows very well that the players make such moves in the market and they are not being punished. Instead, the small traders are being warned or punished if they are not following it. So that is how the lawmakers are supporting the big players. Because you and I as small traders are not parting any money with it of the big decision makers. Whereas the big players are able to part easily the money because they exploit the market and earn huge profit, and they are able to share it with those people who are supporting them. So in such a situation, there's no point in blaming them, and they are the market maker, they are the market facilitators. We have to take into consideration it is going to be a sea with the waves, but we should learn how to swim in such a sea. There comes our skill set of earning money along with that of the players rather than simply blaming the players. So what you have to do is, the net change is the one which indicate till end of the day it will continue to fluctuate. It refers to nothing but how far the currency has moved on the positive direction on the upside or on the negative side on the downside from that of yesterday US session close. For the entire day it is applicable. That is why I'd say that use the GMT time frame to follow the market. Once you use the GMT time frame to follow the market, then you'll be able to understand market is a continuous process from 0000 hours to 2400 hours. And this GMT time frame It's very easy. If you go to my website, iknowindices.com, here you come across on this side your local time as well as the GMT time frame or given. So you simply follow that. The local time is taken from your computer and the GMT time is being calculated based on your geographical positions. And each country will have a time differential from that of GMT time frame. The GMT time frame is calculated from that of Greenwich Meridian time, which is closer to that of London. And you know that international date line is opposite to that of the GMT, that is very close to that of Honolulu, wherein when the sun moves or when the earth rotates and that point is crossed, then you find the date changes. That is why it is called as the international date line. So please understand these geographical principles. They are not very difficult. In schools you would have studied, but you would not have understood. And some people say that it is 2 p.m. GMT. GMT has to be expressed in 24 hours. And it cannot be AM and PM. It shows that we don't give much importance in following it up. If we give much importance to following certain simple things, we'll be able to really fine-tune our mind in the right direction. Then understanding the market, understanding the players becomes much easier. It is a child's play. It is not difficult at all understanding other human beings' mindset. Suppose somebody is standing in front of you and is angry with you. You can easily recognize that he is angry. You become cautious, he might slap you. You become defensive. Similarly, when somebody is laughing before you, you understand he is in a jolly mood and he is not going to cause any harm to you. And when he is ticklish, sometimes pretend as if he is smiling, but actually he is hiding the anger. Still, you can identify that from his facial expressions. So, reading the intentions of the person when he is standing before you is possible. But unfortunately, the players are not standing before us. So, we will not be able to read their intentions directly. Suppose somebody is coming to a shop, you are owner of a shop. Somebody is coming there and asking the price of certain things. Then you are able to easily visualize and judge whether the person is doing window shopping or genuinely interested in taking the material from you. So based on the interest shown by the other person or the person who is willing to buy, you are able to understand whether he is going to be a serious buyer or he is a casual, he is making some casual inquiry. So in the same way, when the player is not available before you, you may not be able to read their intentions. Doesn't matter. But the players have got the market before them, and whatever the intention, they have to express it in the market. So if they want to rise euro, as they are cunning, first of all, they have to quickly dip euro so that it will give the impression that euro could make a free fall. And immediately somebody say that ECB is trying to do something. That is why euro is making a dip. So you will give some attribute in the media. If you listen to the media, then you become bearish. Whereas if you look into the live market quote page, you find that, okay, they are making a dip, but they are not breached the low. It is hardly about 10-15 pips. But when the moves are only 2 pips and 3 pips in the chart, when suddenly 10 pips move happen, you come across a big red candle forming. And the chart size will be for about 15 pips magnified, then 10 pips will be shown as a big red candle. But actually, it would just made a dip for 10 pips. But when you look into the live market code page, you can understand they made only about 4 pips dip and they are not breached the low. So it is only a cunning move on the downside, pretend as if euro is going to fall. Then what do? You watch for 30 minutes. What is their intention? Okay, are they cutting the low again and again, or simply making a dip and hold and gain back, dip and hold and gain back? That means what? They dip, induce the traders to keep sell order and they buy. Dip, induce the traders to keep sell order and buy. When they are buyers, are they going to drop big? Not at all. They are going to rise quickly on the upside, then book profit. Okay. So any quick move in the market is a false move. Read their intentions. Such quick moves are false moves. That means they pretend as if the market is going to fall, but they wanted to gain level. So you buy there. Okay, still you have the fear it might have a free fall. Then instead of a stop, use the hedge order as a trading strategy, limit the risk. So you have to identify the initial lows and the highs set for that day by 3:30 GMT, and those levels are being followed by that of the players. So you are also following it to read their intentions. Then afterwards, you find that whether the market is near the low or near the high. When the market is near that of the high, not breach the high for more than 30 minutes, then you take a sell position. When the market is near the high and breach the high every 30 minutes, then you take a buy. Now what happened? When I was talking, it was showing 1.0999 as the high. And now you find that 1.1004 as the high. Now let us compare the market with that of the initial lows and the highs, so that we'll be able to really understand where the players are. Okay. Now I got the initial lows and the highs. So okay. The initial lows and the highs set for today. In the case of euro, 1.0974 was the initial low, and 1.0999 was the initial high. So you know that up to about 8:30 GMT, they are not breached the initial high, and they started going about to 1.1004. And in the case of GBP, 1.2288 was the initial low, but this shows yesterday's low. This is how the platform providers, they wanted to misguide, and when they come to know that I'm using it extensively for me and for my traders, then the platform providers started using this sort of things. But anyhow, we can just use 2-3 code page and get the right code page. Similarly, you find that when I requested them to give the GMT time frame, they refused to give it, and they wanted to say that only local time can be given, but I can take the GMT time from somewhere else. So this is how we have to think of an alternative. Then in the case of GBP, 1.2288 is the initial low, and 1.2313 is the initial high. They just breached the initial high, went up to 1.2331, holding above that of 1.2313. So it shows that they are holding above 2313, wait for 30 minutes. They still continue to hold for more than 30 minutes. That means already they are holding above that 1.23 for more than 30 minutes. You know, when I was talking from 8 GMT, this 9:15 GMT, they are holding high. And they are expected to gain the level slowly. And also it is confirmed in the case of Euro, they just continued every 30 minutes breaching the new high. That is a slow intentional move on the upside. So they just go set the high, then make a small dip and go up to the high and they make a small dip. What they do is they just buy 20,000 lots, sell 10,000 lots, then buy 20,000 lots, sell 10,000 lots. What happens? So they continue to have 10,000 lots with a nominal profit, but they are just pushing the market higher. So when they are pushing the market higher, they keep high level buys, high level buys, high level buys. Then the market slowly go up. That means they are continuously buying, placing buy orders, regular buy orders and buying it. So when they buy here, that means they wanted to rise the levels intentionally. When they quickly rise the levels, their intention is to gain the levels without making much of a buy, and they wanted to liquidate their lower level buys. So when a quick upward spike happens, it is not bullish at all. The players want every analyst to say that the market is bullish, so that the traders will all come and buy at a higher level after the rise. But the players will be the sellers. How cunning they are. And this cunningness is continuing for the screen is blurry. I'm not able to. You want me to? Adinda, will you be able to tell me whether the screen is all right? Because I'll not be able to check whether what is visible. Because for me it shows live and it is working perfect. Anyway, let me continue this. By the time Adinda might give a reply and say that what is the moment. Now in the case of yen, 103.66 is the initial low, and they came down below that 103.41. Because it is a question of only Hangout, which is a tool we are using to publish it. And I don't know why it is blurry. Does not show clearly. Can anybody just say that it is the same for everyone? So in the case of yen, 103.66 was the initial low. It has come down. Probably your camera. No, it is not my camera. I'm using it. Only when I show myself, I'll be using my camera. But when my desktop is being shown by that app, it is a Hangout we are using. So there is no question of camera involved to show that. It is something like sharing my desktop. There is no question of focus involved. Then in the case of yen, They have come below that of 103.66 and still holding below that, indicating that they wanted to make a drop. More than 30 minutes they are holding it. Then the high was 103.95, which was not breached. Okay. Then CHF 98.75 is the low and 99.06 is the high. They are not breached the low or the high. So that indicate that they are simply holding CHF without making much of an upward or the downward move from that of the Japanese session up to that of the current level. Still they are not breached the low or the high in the case of CHF. So they are not really worried about CHF now. They are focusing elsewhere. So in the case of Euro, they just breached the initial high. In the case of GBP, they breached the initial high. In the case of Yen, they breached the initial low. All the three, they are showing that USD weakening move. And the net change is also continuously showing that. Then in the case of Canadian dollar, 1.3083 is the initial low, 1.3114 is the initial high. They breached the high, but come down below that of the initial low. It is a brief upward stop and then they are making a downward move. It is negative net change. So it shows that they just made a brief upward stop and to come lower than that of the initial high. And then they will come down below that of the initial low, make one more downward stop and then go up. So normally in the case of CHF, they do either way stop and move because relatively the volume is very less when compared to that of other currencies in the case of Canadian dollar. Then in the case of Australian dollar, 76.63 is the low and they just made a brief downward stop into 76.60 and come above, and 76.91 is the high. They are not breached it. So here again they are simply holding Australian dollar and they are focusing on Euro, GBP as well as USD. So if you take a decision to take positions in these three currencies, we will be able to earn quickly some money within the session. Instead, if you take a position in the case of USD CHF or Canadian dollar, at least they breached, they made a upward stop, but now they are holding. So currency like CHF, when they are not breached the initial low or the high for 9 hours from the start of the day, that means they are simply holding it want of volume. So wherever the volume is there, they are handling it. What is the main purpose of making swings in a market, making such moves in a market? See, if Euro is staying at 1.099497 continuously for 5 hours, and if the banks say that, okay, if you want, you sell it here, if you want, you buy it here, nobody will initiate a trade. Everybody will say that, no, let Euro come down, then I'll make a buy. Or let Euro goes up, then I'll try to take a sell. That is how they will take the decision and wait. Look into that of the charts and keep a buy limit order 1.0940 or 50 like that. Think that it will come down at that time, I'll buy near that of the support or sell near that of the resistance. This is what the intention will be. But when they quickly make a rise, then a trader who was willing to buy at a lower level will become emotional. You will feel that I missed the bus, Euro started going up above that of the high. So let me buy before it goes up further. So he buys after the rise. Similarly, when they hold and make a small dip, it gives that impression to that of the trader. He wants to sell at 1.1020, a resistance level. Instead, when it makes a dip, you will think that no, it is not going to rise. It is not having that strength to rise. So let me sell. So when they make a dip, the traders sell. When they make a rise, the traders buy. This is what the normal tendency is. When everybody started buying, I also go and buy without knowing what is the purpose of buying that. And suppose about 20 people are crowding there and saying something, immediately we have the tendency to go and just peep in and find out what is happening. If somebody is selling a product for $1, then you think immediately, yeah, why not I buy also $1? Without understanding whether the product will be of any use for you, whether it is worthy of $1, whether it is a fake or is just trying to cheat, you don't look into all those things. You simply buy it, and if it is not working, you will simply say that it's after all $1. So just for the kick of it, I just bought it. So you give excuses for yourself. This is a normal tendency of a human. So when the euro started gaining, then immediately you go and buy. When the euro started dipping, immediately go and take sell. So the players make the swings around the same level for 5 or 10 pips, mainly to induce the traders to commit positions. Then later on, they take off, either on the upside or on the downside. So when they make small moves like this, technically people call it as consolidation. It's not consolidation. It is simply holding, making the market appear floating so that the traders might commit position. So it does not indicate anything like, okay, the candle formation after 2 green candle, 1 red, after 3 green candle, 1 red, and this can give this sort of interpretation. They're all nothing but the imaginations, assumptions for the time being. And later on you find that situation might differ. But ultimately you don't have a foolproof method for that. But what you can do is, if they don't breach the high for 30 minutes after forming the high, then you can understand they wanted to make a slide. But they have formed a new high, and if they hold above that of the initial high for more than 30 minutes and not coming below that of the initial high, that means they are consolidating here to make an upward move. So you will be able to easily understand what sort of trade you need to do. Whether you have to do a high level sell and a buy after the drop, or a high level buy envisaging further rise and buy book profit. So this sort of decision can be easily done if you note down the initial lows and the highs. And also you'll be able to select the right currency pair. Now let me go to that of the slide. Now these are all the market timings. So from 7:30 GMT up to 13 GMT is the European session. From the last day, 31st of October, we'll come across in Europe, the daylight saving system will be switched off. Then the market, European market, will start by 8 GMT. Let me just take the positions, then later on explain to you. So as I explained that, they just breached the initial high and holding euro closer to that of the high, not breach the low from the start of the session. So we will try to buy euro about 5 pips below that of the current market level. That is why we go in for a 5 pips or 10 pips below, depending upon the swing they are doing it. I'm just going to that of the editing mode so that we'll be able to enter. Okay, in the case of euro, we'll be placing a buy limit order. 1.0994 is the current level, so we will keep it as 1.0990, just about 4 pips below that of the current level, a buy limit order. That is fine tuning it, because we know that they will make a small 5 pips or 6 pip up and down move. At the time it might get filled. Then exit, aim for about 45 pips profit to start with, 1.1035. Then you have to keep a stealth stop or a hedge order. In the MT4 platform, they call it a sell stop, 1.0960. Then in the case of GBP, as I told you that they are holding around 1.2313, the initial low, they are coming closer to that. So we'll try to keep about 5 pips below probably, or 3 pips below. They might make a small dip and then go up. 1.2309 as a buy limit order. And exit 45 pips above 1.23. By 4 and the sell stop 1.2279. $30. And in the case of yen, as I told you, that they are holding below that of the initial low for more than 30 minutes. So we'll take a sell limit, 103.66 was the initial low. So we will keep it as 5.3 or 5 pips above and take profit around 103.10 and this buy stop. There is a high level hedge order 103.83, 30 pips above. So these are all the orders I just placed. If there is a question, can we trade during the gap time? You can trade understanding the quick moves they are doing it. In 30 minutes, you should be able to earn nicely if you learn the art of trading during gap time. So these are all session-wise trades, the basic trading strategy. So I just kept fine-tuned the entry, just keeping about 3-4 pips below that of the current market level. So when they make a small dip, we'll be able to get the fill. See here, they are coming below that of the initial low, just to hit. See, now it will become a position. Once the ask also come to 1.2309, then we'll get it filled. Okay, so instead of buying at the market, when I buy at the market, I have to buy it at a higher level, the ask level. But if I keep the buy limit order, once the ask level comes quickly down and go up, at that time it will get filled. That is the fine tuning of our entry. Why we need to fine tune? So that the chances of the stop being hit will be very less when you keep 30 pip stop. Simply you buy market and later on ask somebody, where do I keep the stop? Where is the support? So can I keep this below that of the support they stopped? All those questions you ask after committing emotionally position. Instead of that, control your emotions. You wanted to earn money. So you have to really understand the market moves and then understand the limitations of the players. And also the player follows certain ideas and you also follow the same ideas, then you'll be able to understand their language. Suppose the players are talking in Greek, then you need to learn Greek and to understand. Instead, you simply say that I only know English, so I want the players to talk in English. They are not fools because they wanted to talk in Greek in order to cheat us. Suppose you go to some foreign countries where your language is not being spoken and you go to their shop and bargain. Then immediately the shopkeeper or the staff in the shop will ask the owner in the language in which you do not follow. Why? Because he wants to cheat you or he wants you to get convinced with the price. So the owner will say that no, it will be below the cost. We will not be able to give. Okay, there will be some marginal profit, so you can give it. Like that, they give the instruction in their local language. This is the customary everywhere in the world. No, where a foreigner goes there, they speak in a local language and discuss. Suppose you happen to know the local language, and when you just reply without your knowledge in the local language, they talk in a different language. They choose another language and speak. That is called coded language. So you always understand that when the people need to cheat you, they need to have effective communication in different language. That is what they are trying to do it now by setting the initial highs and the lows. So when you follow that, then you will be in a position to earn. Now we get that fill in the case of GBP. So GBP limit has become a position. So this is how we fine tune our entry, whereas euro still it is not being filled. We'll watch, and USDN is also not filled. Now let me go to that of the study of the market. We need to understand every session the players make up and down moves in the market. They may call it simply a bearish move on the upside, bullish move on the upside or a bearish move on the downside. And they may simply say that there is a bear cartel or a bull cartel. Or they can use various type of terminologies in order to convince the traders. And these terminologies are mainly used to give surprise to that of the traders. And day in and day out, they can only do two possibilities. Either rise the market or drop the market. Nothing more than that. But they want the traders to follow it interestingly. And instead of you asking whether the market will fall or rise, they will simply say that, oh, it depends upon ECB's decision. It depends upon the outcome of FOMC. So easily when they say like that, you think that, oh, that is very important. And you know that in the first week of this month, when non-farm payroll was announced, everybody was telling that USD has to gain big during this particular month. And when when non-farm payroll was less than expected in the early week of October, to everybody's surprise, euro and GBP went up. Then immediately people thought that it is going to be a bull run in the market. Then immediately you start finding that this market started sliding. Then everybody said that US dollar has to gain again. Because of US election uncertainty, people are not taking big positions So automatically the market is sliding. So every move, they give a different interpretation. They are all nothing but the attributes. What is most important thing is the players gain the level and book profit of their buys and then allow the market to fall to buy back. Nothing more than that. So we need to read that rather than focusing on various attributes given for that market moves in the form of market commentary. There are many people who are good at giving market commentary and they add emotional expressions as spices to that of the or flavors to their food, so that you find that invariably they are able to convince the traders. So that is their skill set, ability. So what is more important here is read the intentions of the player. Now GBP is coming down a little bit. So watch carefully how they are doing it. Pip by pip, if you watch, you will be able to really appreciate what sort of moves they are doing it. For that, we need to understand the type of moves. There are three types of moves, basically, based on the time frame they take. The moves which are happening in less than 30 minutes. The moves which are happening for more than 30 minutes up to 2 hours. Then the moves which are happening more than 2 hours and for more than 2 sessions. These are all the three categories of moves. Why they do that? Now, these moves, less than 30 minutes moves or quick moves, as I explained, quick moves are false moves in the market. And during that of the mid sessions, they do the swings. Now, what you come across here is the swing in the market. They make small up and down move. Thereby, the traders will commit positions. Then later on, they will show how exactly the market is going to move. So, in order to read their intentions, we need to identify the type of moves. For that, we use the initial lows and the highs. A stop hunt is a move which happens less than 30 minutes above that of the initial high and come down, or below that of the initial low for 15 to 25 pips and go up. So above that of the initial high or below that of the initial low, if they make a quick move for less than 30 minutes, so go above that of the initial high and come below that of the initial low in less than 30 minutes is a stop hunt. Similarly, below that of the low and come up is a stop hunt. See, now in the case of GBP, they pretend as if they are going below that of the initial low and coming up. So these are all nothing but small swings inducing the traders to sell. So that when the traders think that, okay, GBP is not going above that of the resistance, so it's better to sell. So that is how they want the traders to perceive. And that selling, the players are buying. So we'll know end of the session what was their intention. So to understand the intentions, we need to find the type of moves. So in that, the other basic classification is quick moves or false moves in the market. If they make any quick move in the market, it is a false move. If they make a slow move, pip by pip, it is an intentional move. So when they make pip by pip, only in a live market put page, you can understand that they are making pip by pip move. But when you look into that of the chart, then immediately it will give the impression to that of the trader that chart is not moving. It is making small one pip up, small one pip down move, and it is sluggish. Market is not having strength. So that sort of feel you develop, but you fail to understand why such moves are happening in the market. See, every move has got a purpose. The players are not doing it just for the kick of it or not playing around. They are making it as part of the earning process. So, like a shopkeeper, they display all the material, and if they are having the toys, for example, for the kids, and they have to keep it in an attractive condition, only then the kid will be attracted. Suppose they have got some electronic toy which can move, then whenever the kid comes to the shop, they will make it move. Only then the kid will be attracted towards the toy and say that I want to buy the toy. So in the same way, they make us kiddish. They make us to feel euro is going to drop or GBP is going to drop, and then we will take the sell position. For that, they flow to the market like this, around that of the initial high or initial low. So we need to read what they are trying to do it. If it is a quick pip by pip move on the downside, very quickly and no retracement, then you can understand that they are going to drop. But they are only pretending to drop, but again gaining up. So that means they dip, induce the traders to take sell position after losing patience, and then gain back again, buy all the sells which are placed on the other side. That's how they do it. So for that, they make upward stopping before making a drop, or a quick downward stopping before making a rise. So a stop point is the one which is above that of the initial low or below that of the initial high, below that of the initial low or above that of the initial high for less than 30 minutes. Now in the case of GBP Euro, they went above that of the initial high and stayed there and then come down a little bit, but they are making that swing near that of the initial high, 1.0999, making the swing near that of the initial high. So here what they are doing, they just made a brief upward stop and pretend as if it is going to fall so that the traders will sell. But in the case of GBP, they've been holding above that of the initial high after forming the new high, and they are holding around that of the initial high. So in both, they are holding around that of the initial high to slowly gain the level on the upside after making swings. Once the traders commit more and more positions, every 10-15 pips gain, they will absorb all the sells. Then quickly gain the level so that the traders who have gone short will go in for a short covering and the players happily sell to them. This is what every time they do. So we need to read that. A false move is the one they make before that of the spike. Suppose they are holding near that of the high and they wanted to make an upward spike after a speech or after a data release. What they do is they dip quickly up to that of the low, pretend as if it is going to fall, and it will be a very quick downward move, especially before that of the non-farm payroll or FOMC meet. We'll find suddenly the market will gain momentum and they will make a dip quickly. And you know very well that none of the traders will commit positions before the data release. And it is a normal trader tendency to find out what is going to be the outcome before committing a position. But what happened? They make a small dip, pretend as if it is going to drop, and then continue to spike up. after the data release or after the event or after the speech. So the false move will indicate, or a stop punt will indicate that what is going to be the next move. After a stop punt or after the false move, the intentional move will follow. So when they make a dip as a stop punt or a dip as a false move, then they will gain slowly for 2 sessions, more than 2 hours, more than 2 sessions. And the third session, they reverse because they don't do hat trick. Hat trick is the one, 3 times a concurrent things happen. Whereas 2 times they do it, pretend as if it is going to continue. Third time they simply reverse. That is why the traders continue to become surprised after their moves. And they are able to successfully bring in the market surprise, the market fear to that of the traders. The uncertainty they are able to create to that of the traders. And they every time give various attributes for the uncertainty. Now currently, the talk for uncertainty being the US elections. Other than that, the British exit. So they continue to keep something for to create or trigger uncertainty in the market. So the traders are always tensed. They do not know when exactly the market will make as per my expectations. This is what most of the traders become frustrated. It is something like standing before that of the sea and say that let the surfing settles, let the waves settle, then later on I'll go for bathing. That is going to be a non-event. So we need to study that type of moves. So we need to study whether it is an up tide or a down tide, low tide or a high tide in the sea. Then accordingly we have to take a decision to go to take bath in the sea. Then extended move is the one which happens for more than 30 minutes up to 2 hours, which is again a quick move. Quickly they gain the level and hit the stops above and hold there for 2 hours and keep that impression to the traders the market is going to really continue to gain level. Then afterwards what happens? They start making the slide after 2 hours. So the slide will be pip by pip. Okay. Now in the case of GBP, they are making a dip. Here comes the advantage of using the hedge. I kept the hedge order in the case of GBP 1.2279. Okay. Suddenly when they make a dip, we should not become tensed. And it might be due to various attributes. And ultimately, what is their intention is vital. The intention initially was to gain the levels, and that is not going to be altered. But they will try to pretend as if the market is responding, even if somebody sneezes, if somebody speaks from that currency, from that respective country, then immediately they make some reactions to that. So such small minor reactions are part of the game. And when they make such move, immediately we have the hedge order to limit the risk. So here, now GBP has come down to 1.22868779 is our hedge order. We just watch. In the even, if it is hedged, we have got a higher level buy, lower level sell. Okay. And you can view it as I got a buy position, when the market goes up, I can book profit. Or I got a sell position, when the market comes down, I can book profit. When both the positions are there, which position has to be handled first? Then we need to find whether the hedge is making profit and loss alternatively, or continuously loss or continuously profit for 30 minutes after hedging. If it is hedged, and for 30 minutes you have to watch forcibly. If it is hedged, and if the hedging is making continuously profit for 30 minutes, that means they wanted to drop GBP further. If they just hedge and the hedging is making profit and loss alternatively for more than 10 minutes, that means it was a brief downward stop, and because they know very well where the stops are placed in the market. They have got mechanisms to learn about it. If there are plenty of traders who had taken the buy position at a lower level or a higher level, and they kept the stops around these levels below that of the psychological level 1.23, then the players come down and hit the stops and then start gaining the level. So they have come to the market to earn. So making the moves on the upside and the downside has got a purpose. So every move they make money. Every move is a decisive move. It is not because of somebody sneezing, some data release, etc. So that is what I told you, that they wanted to make a drop and create uncertainty, but non-farm payroll was less than expected. Then the market went up, then subsequently they made the drop. So that is what we need to understand. So if you think that if non-farm payroll is negative than they expected, and if you assume that Euro and GBP will continuously rise from that time onwards, you might be cheated. So that is for that particular day or for that session. And subsequently for the other sessions, they can always give different type of attributes. So that is what you come across, that traders' perceptions. So traders envisage what is going to be the outcome of FOMC, what is going to be the outcome of British exit, etc. And you know, when Euro and GBP were to the extreme level, when Euro GBP cross was almost to that of 0.98 level, everybody was telling, the analysts were telling that Euro and GBP could merge. Then subsequently, you know what happened afterwards? Then Euro continues to remain as a currency, GBP continues to remain as a currency, nothing happened. And if you look into that, already there are only about 4 majors now. And these 4 majors and 2 commodity pairs, the players have to move and bring in volatility in the market. If they simply merge GBP with something else, or if they simply eliminate it from the major status, then they are not going to have a lesser number of currencies. Already, by combining all the other European currencies when Euro was brought in, then you know that the players made a big drop. When Euro was introduced at 1.47, they made the drop to 0.77 level. 50% totally they eroded it. At that time, it was only a tradable currency. Then subsequently, when Euro was introduced as a physical currency, the players started gaining their levels. You know, in 2008, they gained that level of 1.65 in the case of Euro and GBP to 2.18. So all those extreme moves, they do it in the market. Not just to give any glory to the currencies. They want some instruments to be there. As long as those instruments are leveraged trading, they know very well the trader who has taken a position has to necessarily liquidate the position in the market. He cannot take delivery of the product. Unlike the stock market, where you can take physical delivery. Here you can take physical delivery with the currencies, but if you go to the bank, if GBP is trading around 1.2291, if you ask the bank to give GBP, they will give 1.20. 200 pips away from the market they will give. That is how the products are structured, so that the traders are being trapped again and again. So understand that they make such moves in the market. Now it is still not hedged. They started gaining it. Because if it is hedged, I thought that I can show you live how to wait for 30 minutes and do it. They're not given that opportunity. The extended move is the one which happens for more than 30 minutes up to 2 hours, which is again a quick move. In first 30 minutes, they set the high, and afterwards, or low, afterwards, they don't breach that high for 30 minutes, 2 hours, and then reverse the market and slowly drop. Similarly, they make a drop, hit the new low, set the new low, and hold below the initial low for 2 hours. Then reverse the market and go up. And that will be an alternate move with that of extended move. So in a day, what they do, they make the extended move followed by that intentional move. Then intentional move followed by extended move. Extended move followed by intentional move. Is it difficult to follow? Once you identify the move as an intentional move, which is happening as a slow move on the upside for 2 hours, I mean, more than 2 hours up to 2 sessions. Third session, they will make the reversal. How they will do it? They will make an extended move. And in between, during the session start time and the session close time, they make the stop loss. Before that of the data release, they make the stop, false move. During that of the gap time, they make the false move. Then swings during the mid sessions. So at that time, they hold the euro high, dip GBP in order to rise euro GBP cross. And similarly, dip euro, rise GBP, so that you find that euro GBP cross comes down. So that way, they handle the crosses during the mid sessions. For that, they make the contrarian move. Suddenly, you find the pip changes vary here. Earlier, they have been showing the USD weakening move. Now we come across mixed moves. Euro is showing USD weakening, USD yen is showing USD weakening, GBP is showing USD gaining move, CHF is showing USD weakening move, and Canadian dollar and Australian dollar are showing USD weakening move. But GBP is showing USD gaining move. This is mainly to handle the cross. So you have to understand during the mid sessions they will do the swings between the high and the low without breaching the high or the low. That they do it in order to handle the crosses. So what they do it during different times of the day, that during the early and the late sessions they handle the majors. During the early and the late sessions they handle the majors. During that of the mid sessions they handle the crosses. So if you want to trade in cross, then choose the mid sessions and try to take the positions. So after taking the position during the early session, during the mid session move, if you close it, then later on you repent. When they made a brief downward stop and you have taken a buy, and later on they are just gaining the level and swinging, if you lose patience that they may not gain, or if you simply assume euro is not having strength, it is inanimate. Euro is not a living object, and euro level is nothing but the ratio. The level has to be raised by a human being. And once the level is raised, then you call it as bullish. Once the level is dropped, on their own it cannot. Somebody has to move it. So they are moving it during different sessions of the day, and sessions during different times of the day and during different sessions. So you need to understand when they are going to do what sort of moves. So in a day of 24 hours, they will start with that of the upward or the downward stop. To start with, widen the spread between the high and the low. 0, 0, 0, 0 hours, if you see, the high and the low will be the same level. The market will be around the same level. Then slowly they will gain the level or drop the level and spread. They increase the gap between the high and the low. Then around 3:30 3:30 around the early session, they after that of the early session, during the mid session, they set the initial low and the high from 2:30 to 3:30 GMT. That is during the mid Japanese session. Then afterwards, use them as the referral levels and continue to make swings in the market. Then from that of 5:30 GMT up to 7 GMT during the late Japanese session, they will handle the majors and continue to breach high or low. Then the gap time comes, they will make false move. So initially they will make upward of the downward stop band. During that of the late session, they will make upward of the downward stop band. During the gap time, the false move. Then again upward of the downward stop band during the early part of the European session. During that of the mid session, the swings in the currencies, contrarian moves. Then during that of the late session, they will make upward of the downward stop band. And then again false move here. If there is a data relay around 12:30 GMT, they will make a false move before that of the data and make an upward spike after that of the data if they want to rise. Then during the gap time, they will make again a dip as a false move. Then during the US session, they will continue to gain early session and in line with that of the sentiment created by the data. Then during the mid session, they will hold and make alternative moves and handle the crosses by making USD gaining, some making USD weakening, and not breaching the highs what they have set. Then during the late session, then again they breach the high and continue to gain, induce the short sellers to do the short covering at the late session. Because once they squeeze the market around 20:30 GMT, afterwards if you hold the position, the platform will charge overnight interest. So most of the traders, they will close the position because of that. So they know very well the players squeeze the traders at that time with a quick upward move. Automatically the traders gone short will go in for a short covering. So this is how every day they make the moves in the market. But every day you find that, okay, today it is ECB day, today it is BOE day, today it is non-farm payroll, today it is FOMC, like that we talk. But players make up and down moves and earn. For that, what they have to do, create the market sentiment and act against it of the traders. So if you simplify your understanding, then trading becomes a child's play. If I got any doubt, you can ask me the questions. I will answer these questions. Now in the case of Euro, they are making a small dip. Now only GBP we have taken the position. Euro, our order is very close, but still they are holding it. And yen also they are not gaining it. Actually, if you would have just taken the position around 8:30 GMT, then it would have been better. But what happened during the early session? But without explaining anything, if I simply take the position, you might think that I'm trying to show that I'm a great trader. But I want you to become a great trader. I don't want any appreciations, because ultimately a teacher is the one who expects the traders or the students to use the teacher as a ladder and climb up rather than trying to appreciate the ladder. So if you are not able to follow anywhere, you can ask me the questions. I'll be willing to answer those questions. See, the basic idea of staying here for a longer duration is mainly to give more clarity to the other traders. because it is totally a new concept. It is not the chart study and things like that. So if you want to understand the new concept, obviously you have to keep open mind and follow it. And it is full, nothing but logistics, nothing but a logical derivation. But still, you need to follow it carefully. Only then you can master trading. So no question is coming forward. I forgot to show you the forecast for the day. This is the forecast. Today we are on 19th of October. Swing and slide during that of the Japanese session, and then swing and firm up during that of the European session, and then swing and drop during that of the US session. They are all the expected market moves. So the firm up is expected to happen by 13 GMT. At the time, we should book profit in our buy position. Then later on, we can do sell and buy trade during the US session. So if you've got any doubt, you can ask me. I'll be willing to answer to those questions. If there are no doubts, then probably I'll wind up the webinar. You can track the market from now till 14 GMT. I'll come back by 14 GMT and explain to you what happened to the trades and also take new positions for the US session. So I take this opportunity to thank FX Street for the facilities provided to present the webinar. So part one, I'm just concluding it because there are no questions asked. And if you've got any question, if you want to ask me again, you can make a note of it and continue to ask during part two, because this session is exclusively dedicated for trading strategy, so that you'll be able to understand how trading strategy can be effectively used to limit the risk and maximize the profit. Wish you all happy trading. Come back by 14 GMT. I'll come and continue to give the trading explanations by them. Thank you.